Hey, it's Saylor, and this is episode 130 of the Orange Pill Investor. I just actually went over 1,000 followers. I may do some kind of thing where I let people maybe decide what to cover in honor of that. I've been thinking about something like just an exhaustive kind of all-inclusive options, I guess, tutorial, guide, whatever. Basically a write-up and video to go along with it. That would probably be a marathon. Or maybe if people are interested in going over the options profit calculator more to figure out how to mitigate upside versus MicroStrategy, something along those lines. Or I may do something a little different even than that, maybe some kind of lottery or something. We'll see. So, stay tuned for that, I guess. And what I'm really talking about today is just the aftermath of MicroStrategy going up this week. And, my entire portfolio could have been up 55% if I wasn't selling covered calls. However, I'm only up 47%, and that's the entire freaking portfolio. Now, that is completely out of the ordinary. It's probably the most my account has ever shot up in 1 week, and it's a result from doing some fairly risky things. So I was fairly margined. Did not have a lot of buying power left, so I was margined to the gills. And things like that will allow you to leverage up on a good week. So those types of returns are not normal. However, the point of me even mentioning that is just to kind of talk about how I'm not too fussed about limiting my upside, even on a sharp move like this. Now, I did get wrecked when MicroStrategy within 2 to 3 weeks went from 500 or 600 to 1,500 and then 2,000. So I lost out on a ton of upside when that happened. However, I've kind of readjusted my strategy a little bit, and yeah. So to have, I basically paid like 30 grand. Oh, was it 25 grand? Anyway, yeah, maybe 20 grand on I had the 1370, the 1380, and the 1400 strikes. I wanted to go closer to 1450, but I got a little bit too greedy with the premium. So I probably would have only been able to capture like 0.5% at 1450. And I really just, I don't know if it's that I didn't follow my instincts or whatever, but it's not an exact science. And I don't know if technical analysis would help. I kind of consider it financial astrology. So other than drawing like support and resistance, I don't really bother with it. I just eyeball it. I've been doing it long enough now that like a lot of people just go to the 0.3 delta. They just, no matter what, it's 0.3 delta. But I use that as kind of like a starting place. But really the main point is that, okay, I limited my upside by 8%. And so if I capture 15% up moves, if that happens a half dozen times this year, and I capture 15% of a 20% move, or I capture 20% of a 30% move or something, now MicroStrategy could be just off the chain, though. This is one that does scare me a little bit. So I have gotten a little bit more conservative. I won't carry covered calls over earnings, especially the FASB earnings, if that surprises the shit out of people. But yeah, this will probably be a quick video. It's just to kind of go over why it doesn't bother me that I missed out on. Yeah, so I had to pay actually I rolled, yeah, I think it cost me about, well, what did I get paid? Let me look and see. All right, I got paid 1,900 on this one and 1,500 on this one. Whoops. So yeah, on this roll, that was actually the final price. So if I got to add like $2,000 to that, so maybe I would have made 56% without the covered calls. But I'm more than happy with the 47%. Trust me, I am ecstatic. And so I know a lot of folks say you never sell your Bitcoin, you never sell MicroStrategy or whatever. But when you are absolutely just levered up, I'm in a group called Irresponsibly Long MicroStrategy. And if you are irresponsibly long on something, I mean, you're just margined, you're levered up, that's a completely different situation than someone who's in a cash account and they have no risk of a margin call or anything like that. So, and not to give away too many details, but I've actually borrowed money to buy shares of MicroStrategy. So, like, I don't know if there's a higher level of degeneracy than that, but yeah, I definitely did it. So when you win big like this, well, I shouldn't say you. I never really tell people what they should do, but and it's never not financial advice. But for me, if I win big, I got to take some risk off the table. So that's why it was perfectly reasonable to me to peel off, what was it, like 73 shares or something from MicroStrategy that I sold around 1,500. And I redistributed some of those to mining stocks, which I don't love as much as MicroStrategy. MicroStrategy is the only stock that I truly am enamored with. But I also love Tesla. They are my second best in an era of there is no second best. Tesla's my second best. So I added a bunch of that, and hopefully it'll trick, not necessarily trick, but it'll make Tasty Trades concentration risk in their algorithm a little bit happy. Well, I think when I had like less than $20,000 of buying power available, I was still trying to add MicroStrategy shares when it was like $1,200 a share, and they were not happy about it. I was not buying it on margin, so there was no discount. And actually, I want to check something before I forget. Let's see what happens if I try to sell a put in MicroStrategy for next week. So if I sell just under at the money, let me see if why would that increase my buying power by that much money? Oh God, that's a long put. Good Lord. No. Short put. That would reduce my buying power by 78 grand. Yeah, so basically half, which makes sense. That's usually the discount they give me when I'm buying shares. If I wanted to buy 100 shares, yeah, margin check. Well, I don't even have enough money to do that. I just wanted to see if they were going to give me a good margin price on that, which is not bad. Maybe 45%, 55% maybe. So taking shares off the table made sense for me. I feel a lot more comfortable about my margin risk with more buying power available. This is closer to like 20% of the account value, where before when I had there were a couple of times when I had almost no buying power whatsoever, and I was like, okay, am I going to have to break into some emergency funds and to cover a margin call? So that's the other thing. If people see me trading margin, I don't want them to think that that's normal and you can just YOLO this type of shit. I definitely have other resources, liquid resources that I can just tap and avoid a margin call. I mean, depending on how much it fell. But those are calculated risks. So if you are levered up, so not only did I borrow money to deposit in this account to buy MicroStrategy, I'm buying those shares on margin. So this was leveraged leverage. That's like not necessarily very smart. And I think I even had somebody in the comments, was it on YouTube, that were, you know, basically calling me out for it, like what the hell is wrong with you? You're you know, you have all your fish in one barrel basically, and you're margined up. Like, it was basically kind of laughable that anybody would watch this video and take it seriously. And he has a point. So it was not terribly smart, but when you roll the dice and you win, you gotta take, you gotta just walk away. You know, if you're in Vegas and the frickin' slot machine hits in the first 15 minutes, then you just collect your winnings and you get the hell out of there. So that's what I did. I peeled off a bunch of shares of MicroStrategy. I sold one of the 3 leaps. I've taken to using leaps as upside protection. These 40 shares would probably cover me against a 2K move. They would not cover me against the 2,500 move if MicroStrategy is 2,500 by next week. However, these 2 covered calls might. So this is the November 15th. And I don't like them being that short of an expiration. 180 days is kind of pushing it. But let's just go to the MSTR. And let's select November 15th. I will absolutely not hold any long calls under 45 days expiration. That is my bread and butter. That's how I make my money, selling covered calls. So if I'm taking advantage of call buyers at the weeklies and up to 45 days, then that's where I don't want to be long. And I will actually start getting nervous around 90 days. There are some option sellers that will sell at 90 days and just write it down to like 2 to 3 weeks to expiration and then roll it out again. That's kind of a low maintenance way to do it. I don't think it's optimal. And I prefer the weeklies anyway, but let's just hit up this. So I'm going to select the 3,800 strikes. It's basically the top of the chain. It's the cheapest ones, and they're barely affordable even at that. And let's see, I want to see my results in profits and loss, not a percent. And let's calculate this. All right, this graph is going to be really small on the video, but so just to calculate how much this would protect me up to like 2K on May 25th, if the price is 2106 on May 25th, the price of this option would now be worth 32 grand minus if I paid 16 grand for it today, if I was buying this protection today. So I could basically double up my money. But the price of, let's see, I have the 1800 strike. So if it goes to 2K, I'm going to be on the hook for 20 grand. So this would almost fully protect me. It would protect me 16 grand of the 20. So I kind of like that. I have 2 covered calls and I have 2 of these. So I kind of like that. Now a 2500 move, I would be at 1800 strikes. I'm going to be on the hook for 70 grand each. And these are only going to give me 35 grand in protection each. So I would actually need 4 of these leaps to protect me against the 2500 move in MicroStrategy. And I'm thinking this is going to get worse and worse the farther I go up. So let me just go to 3 grand. 3 grand, I would be on the hook from 18 to 3. That's $120,000 on a covered call, and this is going to protect me half of that. So yeah, but it's a risk assessment. How, like if we just look at the options chain right now for next week, I have the 1800s, and this is just an approximation, but Robinhood is telling me that they think there's an 83% chance that if you sell an 1800 strike, there's an 83% chance that you will win that trade. 17% of the time, which is almost 1 out of 5. So if you do this trade, you're going to win it 4 weeks and you're going to lose it on the 5th week. I mean, you could be unlucky and you could lose it the first week and then win the next 4. And I know some folks have gotten into selling covered calls on MicroStrategy, and that happened to them this week. The very first covered call that they ever sold, they had their strikes breached. So can and will happen, but Robinhood is estimating that there's an 83% chance that this will just be fine, and you'll just collect this whole amount. Now, why did I only get paid $1,900? I think, because I sold them in the morning, and I think the price of MicroStrategy went up from like $1,500 to $1,540. So the delta on this is about 0.24. So that can also be somewhat of an approximation about how often you can expect this to get breached. 75% is it's close enough to 83% to eyeball this and say, okay, more often than not, I'm going to collect this full premium. But it's going to happen enough, with enough frequency, that you have to account for it. But actually, let's go to the 2000. Let's just see how often Robinhood thinks the 2000 strike. Okay, so if this is accurate, and this is just all an estimation, it's just predictions, Robinhood is saying you should only have to deal with a 2000 up move from 1500 7.5, whatever, almost 8% of the time. So if you run this trade 100 times, they're saying 8% of the time it'll run to 2 grand. So is it worth buying these calls to deal with an 8% chance? I'm scared enough of MicroStrategy that I think so. I mean, obviously, because I did it. But let's see a 2500 strike move. They're saying that should only happen 2%. 2 out of every 100 trades should this go to 2500. So maybe I'm keeping that in the back of my mind, but when I'm on Options Profit Calculator and I'm seeing that, wait, was that the 2500 or the 3? Yeah, the 2500. 3000 is going to be even worse, or should I say better? Yeah, 99.5% chance this is a winner, but you're only collecting $100. Like, to me, that's, I'm not putting my MicroStrategy at risk of getting called away for $100. So I try to find some balance. I'm baking 20% call away in here. I'm collecting 1.5% premium. Now, the only other thing that I was really thinking about, and this is maybe ludicrous, but it would take me, 10 weeks of selling 1500 in premium in order to buy that call, in order to get that protection. Now, I had some buying power, so I could just do it. And I also have the shares that are uncapped. I have 40 shares uncapped that are protection as well, that I can peel off. But if I sold these just at the money, I mean, no call away value, this would be suicide to an extent. But collecting 20 grand, I could turn right around and buy this call, have about 3 grand left over, and it would protect, what did we say, at 2 grand, I'd be on the hook for 50 grand, and this would only cover 16 of it. So I don't love it. I think that's probably a bad take. But instead of, if I buy 1 share per covered call a week, and then after 5 weeks, I've got, since I'm selling 2, I'd have 10 shares of MicroStrategy. That would be worth about 15 grand. I could just go ahead and sell those shares and buy one of these. And I may consider doing something like that. The other thing is that when a stock is up, the whole point is that these options go up faster. And so since MicroStrategy has been up, this thing got 50% more expensive, basically overnight. So from Thursday to Friday, this went from like an 11 grand price to a 16 grand price. So that's up 50%, but MicroStrategy didn't go up 50% overnight. So when I'm using my premium to buy more of this asset, when the stock price is up, I will probably buy shares. When the stock price is down, I might be more likely to try to buy these leaps. Buy low, sell high. And then when MicroStrategy pumps, I would probably want to look to sell the leaps before I sell shares. I don't know how much extra profit that would potentially add to the scenario, but it just makes sense to me that if you're going to buy low, sell high, and long calls are leveraged, then the highs are going to be higher. If MicroStrategy goes up, the long call is going to go up at a greater ratio. So I'm almost kind of looking at it like, okay, if the price of MicroStrategy is cheap, then I'm going to buy long calls. If the price of MicroStrategy is expensive, if I still want to buy something, I'm going to buy shares. Because shares are just one delta. They have no expiration date. You don't have to manage them. You don't have to worry about, oh, I got to hurry up and sell it when it gets to 60 days, 90 days to expiration. Share is just a share. It's just low maintenance. And it's one delta. So if the price goes up $1, your share price goes up. Your portfolio value goes up $1. Whereas with these, yes, they're leveraged, but if the price of MicroStrategy goes up $1, since this is a 0.2829 delta, you're only going to get 29 cents per dollar. Now, once MicroStrategy increases, this delta will actually increase as well, and the deeper or the closer to in the money that this becomes, the more valuable it is and the more it actually increases per dollar. So this will not stay the same for the entire life of the contract. All right, that's all I really wanted to talk about this time. My strategy for mitigation and how well I think it worked. I think I did just get lucky with I bought those covered calls. I bought those long leaps, those 3,800 strike leaps to protect myself because I was still a little bit shell shocked from MicroStrategy moving to 2K a month or so ago. So I felt like these. This 3,800 strike in November, I could barely afford it, but I felt like this protected me a little bit better than buying shares. So I think in 100 of my videos, I've probably talked about sell, get 1%, buy a share, sell, get 1%, buy a share. But in this case, since I am as bullish as I am in a MicroStrategy, I think it makes sense to be able to buy these long calls. So I'm glad I did. And if MicroStrategy pumps again, maybe I'll peel another one off. It would have to pump to 2K or more for me to sell both of them and kind of maybe expect a correction or something. And then and when MicroStrategy is that expensive, I would just be buying shares with the premium instead of buying options. But there's no rule that says you have, if you're selling covered calls in MicroStrategy, you don't have to buy shares of MicroStrategy. I've got those 40 uncovered shares, so I can buy a bunch more Tesla, since Tesla seems to be kind of, there's blood in the streets when it comes to Tesla right now, and I think it's just a matter of time before there's a 25K car announcement, a robotaxi announcement, a full self-driving announcement. And even though I don't sell covered calls over earnings, hoping for a gap up, hoping for a positive earnings report, there's just so many announcements that could come out for a company like Tesla that, yeah, I think this is just way undervalued. I don't know what the negative, I don't know, are people nervous that Tesla's, the board isn't going to, or the vote isn't going to carry to give him his awards package and he's going to leave or something? That is an existential risk that would be devastating, at least short term, especially for AI, but hopefully that doesn't happen. But maybe there's just a lot of just anxiety around that. I can't think of what other reason, other than the margins, even though they have industry-leading margins that Toyota and Volkswagen would kill for, the fact that they've come down a few percent, I guess, has soured people. And the interest rates is kind of screwing new car buyers. So I guess there are reasons. I don't think they're necessarily valid reasons for Tesla to be this underpriced, but I do at least acknowledge that there are reasons. So I can sell calls in MicroStrategy and then buy shares and leaps of Tesla. I can buy buy shares of Hut, Riot. The other one I trade as well as Mara, but I do that on my small account. It's the most expensive of the three miners that I trade. So if I want the most bang for my buck, I'm going to buy Hut and Riot right now. All right. I think that's all I wanted to cover. I could have been up 55% in my entire portfolio, but sadly I'm only up 47%. And that is the trade-off. So I don't think it's as big of a trade-off as some of the critics make it seem. They'll say you're picking up pennies in front of a steamroller, but I picked up most of the pennies. I mean, even in front of the steamroller, like, I didn't really get steamrolled for that much. So it doesn't really faze me, and the up plan is the same as the down plan. All right, be good, Joe.